So let's talk a little bit more about, I guess, pricing incentives and bad behavior. And hopefully I can answer Zahaib Khan and Bhavna Saraf. Hi, Bhavna from Lloyd's there. And question perhaps to Swaroop. How is the industry looking? I guess, well, sorry, how are you seeing appetite from various participants in the secondary market, so insurance, banks, funds, for ESG trades? Is there an element of decentivizing unsustainable trade or incentivizing green trade, and what does that actually mean in reality?
Yeah, I mean that's a very there are many questions within one question packed, right? So I would like to cover this in three parts. So generally, trade finance in the investor community interest is increasing, and there is always, I mean, this asset class in general is low risk, positive yield, and a real economy asset class. So there is massive interest in trade finance in general. And the problem with trade finance for the investor community has traditionally been that this is a space which has been mainly led by banks, but investors have not been able to access it because of the ability to access the complexity, the nuances, and the transactional nature. But in case of ESG, this very nature actually becomes a positive, because trade actually offers transactional visibility, end use visibility, and is specific real economy in nature. It makes it very, very easy for ESG assets to be tracked. Therefore, the asset class inherently is very attractive for ESG sort of financing. Now, when coming to investors, now investor community is actually looking at it, and extending on Katharina's point, is that there is work that individual banks and institutions, including us, are doing on integrating ESG in our risk frameworks, right? But that has to evolve a little more. And I think what needs to happen there is that ESG risks have to be looked at not only from historical perspective, but from a future resilience perspective. So the risk modeling within banks has to also evolve, not just on the historical risk data, but also future resilience risk on ESG parameters. And this needs to get integrated in the price, in the asset that the banks and other institutions are originating. And investors are actually looking for that. So once you have, and all these elements are so interconnected. So once you have these definitions which are evolving from different institutions, and hopefully at the end, industry bodies will come up with a common definition which everybody can accept, this will probably create an ESG index or a transparency for investors to access, because investors are actually looking at a straight index which can identify a particular trade finance asset as ESG and having a score or ESG score around it, and then being able to invest. Having said that, that's the end state. In the interim, there continues to be a lot of interest in ESG from investors. We see investors having their own criteria on evaluating these assets. And we are trying to bridge that gap between originators and investors to be able to share more and more investments, assets, to be able to access the green trade finance or sustainable trade finance. You just saw Loan Market Association come out with social loan principles just yesterday. So I think this is a massive space, tremendous interest, but pricing is not the only way to incentivize this, is what I would say. Pricing is one of the tools which will probably which will help the movement towards ESG, but not the only tool. It's the whole movement towards sustainability and ESG as a whole, which will help drive this transition, not just for new businesses, but for existing businesses to move towards green and ESG nature.
And Joe Wissing, what's your view? You're a banker. Are you going to fund assets based on how sustainable or unsustainable they are? Do you have a view on this?
Well, I mean, as the other panelists, as Katharina and as Swaroop have already said, it's really now an integral part of banks' risk frameworks to actually sort of like go through a sustainability assessment. And that's on the one hand, of course, to basically say, is this, for example, like this project that we're looking at or so, is this something that would particularly drive a positive ESG outcome? Versus there is, of course, also the risks of, let's say, are we actually going to finance something that is definitely not positive from an ESG perspective. And again, each bank has got its own frameworks and policies around that now. Most banks obviously publish these. I think what is important against the backdrop of all this is certainly there's been a lot of push by the banks, as I say, to, for example, create designated internal funds that are being used to give pricing incentives, for example. But I think what is really important, what we should not forget is that as banks with long-standing client relationships, we also need to work very closely with our clients to ensure that the transition happens in a harmonious way. Let's say you were to pull out of companies from one day to the other that might, I don't know, be doing coal mining business in developing markets. You would basically have to exit every single commodity name on the planet, right? So it's more around really working with companies and understanding their individual circumstances and their strive towards more ESG enhancing outcomes. I think this is what's really important. And of course, that's important then in particular if you start looking at, let's say, the other aspects, so not just the environmental, but think about the social, for example, like avoiding child labor is something we've spoken about. Complying with, of course, the Modern Slavery Act in the UK, respectively, other similar legislations in other countries is key, which of course can become tricky when you have very long-winded supply chains. So it definitely requires a lot of input, particularly in a trade finance context, from banks to actually really understand their customer and understand their business. And I think this is where we are back to basically banking one-on-one, right? It's all about KYC and KYB and working together and learning from one another.
Thanks, Joe. And actually a question from Hansa Emzivat that's just come in. Do you think that it would be better to only highlight when the asset is perhaps positive, I guess that means greener, instead of actors trying to blacklist or criticize non-green assets, which could even have more of a negative effect?
Very good question, and certainly a controversial question. And I would say, again, this is within, at the moment, this is within a lender's appetite and within the lender's framework. And certainly we've seen a lot of lenders step away from, for example, supporting anything that is coal mining related. And again, there is, of course, an importance to understand individual circumstances of individual countries, right? Me being based in Asia, I'm quite realistic that Indonesia, with a 300 million population on, I don't know how many hundreds of different islands, would struggle a bit to have to power the whole country from one day to the other with wind energy or solar panels, despite their geographic locations. So I think it's also important to understand these aspects. In terms of like not talking about the negatives, I personally don't think that that's the right way ahead. That's basically trying to dodge a risk committee. And certainly at the institutions I worked for, you would easily get found out about that one and would show a very poor record of integrity. So that definitely, there should be no avoidance of highlighting the issues if there are issues. And then again, then it's important, I think, to highlight the issues and understand them individually and discuss them. And that will then be totally in the bank's risk and compliance appetite.
Thank you very much, and there's no clear consensus here. Please do feel free to message us using the hashtag #TradeFinanceTalks across Twitter, LinkedIn, and various other channels to get in touch with us if you guys have any questions. To those of you joining us live across our various channels.